According to data just released this morning from research firm Black Knight, the number of mortgages that are more than 90 days past due is at a 12-year low. Let's bring in Mark Fleming as well with First America. Mark, this is great news, is it not?
Yeah, it's good news. Good news.
Is it going to last?
Not indefinitely forever, but right now we'll take it, right? I mean, we're at a cycle low. That's because everyone has equity in their homes. The economy is great. Affordability and purchasing power is up. So the housing market's in good shape right now, and that's why we don't see delinquencies and foreclosures.
What if interest rates rise? And it's an if because they're going down, but
Right.
what if they do rise?
At some point, they're going to have to rise.
That's what we've been saying for a decade.
3 years on my part, yes. Rising interest rates don't necessarily cause delinquencies and foreclosure, but it's something that will slow down the housing market.
We've seen a lot of news lately that we're seeing riskier mortgages, that we're seeing there's this thing, I won't get all technical and wonky, called the QM patch, which actually allows you to have higher debt and still get a Fannie and Freddie backed mortgage versus your income. With these riskier loans, though, do you expect to see any more delinquencies going forward if people have more debt in their mortgages?
Yeah, so the QM patch is really focused on your sustainable ability to pay, your, leveraging how much of your income per month that you actually put towards the mortgage. That increases the risk of a delinquency. But people don't go delinquent just because they're paying more per month. People go delinquent and then potentially into foreclosure later because something happens in their lives, a divorce, death in the family, medical event, loss of job, which is really related to sort of the economy and recession risk. And so it's if those things happen, there is some risk exposure there by being more, more heavily weighed towards your mortgage payments over everything else. But we've seen that in many times before, and generally that was, in the financial crisis, we'll call it financial innovation, was to layer that with negative amortization, with interest only, with all these other things, and that's not happening today.
And people do have a lot more equity in their homes right now, so if they get in trouble, they can sell pretty easily.
Delinquencies often have risen, but foreclosures have not happened because it takes both to actually loss of equity as well as inability to pay to actually get into a foreclosure position.
I'm going to ask this question for a friend. Is there any sign that this SALT cap deduction, which has altered some real estate markets in the Northeast, high tax states, a lot of our viewers, has that worked its way through the market, or has the market repriced, readjusted? Not at all?
Well, let me put it this way. We've tried to find evidence in the data, and it's very, very hard to find any systemic evidence in the data of big effects there. Even when you drill down into these very, very small micro markets, we just don't see a lot of it. Yet we know anecdotally, from seeing news interviews and other things, that clearly some people are making those decisions. I think it's still going to have to work itself out. The reality of it really just hit a couple of months ago with the first time where you're filing your taxes and actually realizing what it meant to you. But also, the decision to move is much more than simply just financial.